You opened your app this morning and the numbers didn't make sense. Yesterday green across the board. Bitcoin climbing, XRP breaking resistance, Ethereum holding strong, volume was roaring. The whole market felt like it was finally waking up, and then, red, a sea of red, bleeding in overnight. No hack, no exchange collapse. No regulatory bomb dropped. So what happened? Here's the thing most people won't tell you: it wasn't about crypto at all. It was about a 21-mile wide stretch of water on the other side of the planet, and a radio transmission heard by a supertanker captain who immediately started turning his ship around. Today we're pulling back the curtain on something the mainstream financial media barely connects to: digital assets. And once you understand it, you'll never look at a red day in crypto the same way again. Let me paint you a picture. Imagine you're a ship captain. Your vessel is loaded with crude oil enough to power a small country for weeks. You're heading out of the Persian Gulf and there is exactly one route out. The Strait of Hormuz. This narrow channel, just 21 miles wide at its tightest point, is responsible for roughly 20% of the entire world's oil supply passing through it every single day. Think about that. 1 in 5 barrels of oil on Earth moves through this single corridor. Saudi Arabia's exports, WA's exports, Kuwait's, Iraq's, Iran's own, all of it funnels through this one geographic bottleneck. Now here's where it gets dangerous. Iran sits on the northern shore, and Iran has made it crystal clear historically and repeatedly that if it ever feels cornered, it will shut that strait down like flipping a light switch. They've drilled for it, they've war-gamed it, they have fast attack boats, anti-ship missiles and naval mines ready to deploy. So when you hear that the Strait of Hormuz is closed even for a few hours, every single commodity trader, hedge fund manager and energy analyst on the planet goes on high alert. And here's the part that most crypto investors completely miss: when energy markets go haywire, risk assets across the board get hit, and crypto is the most risk-on asset class in existence. Here's the domino chain that happens in real time, and it moves fast. A geopolitical event threatens oil supply, could be a conflict, a naval incident, a political announcement, doesn't matter. The signal goes out, oil traders react, but here's the cruel irony of weekends: those markets are closed on Saturday and Sunday. The energy traders who want to buy or sell crude cannot. Their hands are literally tied. So where does that fear go when it has nowhere else to run? It shows up in the only major market still open 24 hours a day, 7 days a week. Crypto. Bitcoin becomes the release valve for global macro fear. When institutional traders get spooked and they can't reposition in oil or commodities, they pull back from every risk asset they can touch. And Bitcoin and altcoins take the hit. This is not conspiracy. This is market mechanics. Think about it like a river being dammed upstream. The water doesn't disappear, it finds another channel. Fear is the same way. It finds a channel, and on weekends that channel has a big Bitcoin logo on it. So the next time you're watching your portfolio bleed red on a Saturday afternoon thinking, what did Bitcoin do wrong? Ask yourself, what's happening in the Middle East right now? Here's something I want you to pay attention to because it tells you more about where we're going than any chart pattern. Fear and greed index sitting at 58 out of 100, greed territory but sliding. Altcoin season index at 36, both numbers retreating. Now what do these numbers actually mean? The fear and greed index pulls together volatility, market momentum, social sentiment, dominance and search trends. When it reads 58, people are still cautiously optimistic, but it was higher yesterday. It dropped because the mood shifted. And here's what's fascinating from a behavioral psychology standpoint. Markets don't move on facts, they move on the interpretation of facts. Trump says the strait is open. Markets interpret, conflict de-escalating, oil stable, risk back on. Crypto pumps. Iran broadcasts the strait is back under military control. Markets interpret. Uncertainty, instability, risk off. Crypto bleeds. Same waterway. 12 hours apart. Completely opposite reactions. The asset didn't change. The narrative did. This is why experienced traders don't just watch charts, they watch headlines. Not the usual financial news. Shipping lane radio transmissions. Foreign ministry statements. Naval fleet movements. The people who understood this relationship made enormous amounts of money during similar Hormuz tensions back in 2019. The ones who ignored it just watched their portfolios swing and called it manipulation. It's not manipulation, it's macroeconomics. Now here's the part that should actually excite you, because underneath all this geopolitical noise, there is a signal that smart money watches very carefully. Bitcoin ETF inflows. We just saw almost $1 billion pour into Bitcoin ETFs in a single week, the biggest inflow since January of this year. Let me put that in perspective. January was when institutional money came roaring back after the ETF approval period settled. To match that energy right now during active military tension in the Middle East, that is significant. It tells you one thing. The institutions aren't scared out of crypto. They're using dips as entry points. While retail investors see red and panic sell, the big allocators are quietly clicking buy. This is the oldest playbook in investing. Volatility creates opportunity, but only for the people who understand what's causing the volatility. And speaking of institutional thinking, there's another move happening that most people are completely sleeping on. Michael Saylor's strategy is shifting its preferred stock dividend to semi-monthly payouts every 2 weeks instead of every 4. Why does that matter? Because Saylor is playing 4D chess with capital flows. More frequent payouts means more consistent investor attention. More attention means more capital flowing in. More capital means more purchasing power to buy Bitcoin. It's a flywheel, and Saylor has been running this playbook better than almost anyone in the space. You don't have to love the strategy to respect its mechanical brilliance. Here's something I deeply respect about this ecosystem. Even when macro conditions are brutal, the builders keep building. Take what's happening with XRP right now. Wrapped XRP WRP just launched on Solana, and before you scroll past that, let me explain why it actually matters. The XRP ledger was engineered for one thing above all else: fast, cheap, reliable value transfer. That's its superpower. But for years, XRP lived largely in its own lane. While DeFi happened mostly elsewhere, this bridge changes that equation. Now XRP holders can deploy their assets into Solana's DeFi ecosystem, lending protocols, trading pools, yield generation without ever selling their XRP. You maintain full price exposure to the asset while simultaneously putting it to work. The infrastructure behind this isn't a rushed build either. Layer 0 Hex Trust and the Solana Foundation built the cross-chain rails that make this possible. Institutional-grade partners, more access, more ecosystems, more utility, and volume is backing that up. Xrp's 24-hour trading volume hit $4.12 billion, the largest monthly volume move we've seen even as price pulled back from the $50 level it briefly reclaimed. Here's the broader lesson. Price is short-term. Utility is long-term. When the geopolitical dust settles, and it always eventually does, the assets with the deepest utility integrations don't just recover, they surge. So what actually happens next? What are the variables that will determine where this market goes? First, the Strait situation. Does it actually open? Do ships transit without incident? Every hour of safe passage lowers the fear premium in the market. Every report of gunfire adds it right back. Second, ceasefire extension or breakdown. The broader Middle East tension is on a hair trigger right now. Any significant escalation triggers a flight from risk assets. Any diplomatic progress sends them higher. Third, the Clarity Act. This is the US crypto regulatory framework that's been dangled in front of the market for months. Every time it looks close, it stalls. But if it gets scheduled for markup, meaning they're actually moving toward a vote, this alone could override the geopolitical headwinds entirely. Markets are forward-looking machines. They don't trade what's happening right now, they trade what they expect 3 months from now. A credible signal on regulatory clarity could send institutions pouring in regardless of what's happening in the Gulf. And fourth, volume sustainability. We just had an extraordinary Saturday with $166 billion in volume. Does it hold into Sunday? That's your leading indicator for what Monday morning looks like. My honest read: the Iran situation is fluid enough that anyone claiming certainty right now is lying to you. But the underlying signals, institutional inflows, ecosystem development, volume strength are all pointing in the right direction. The wind is at our back. The geopolitics are just a headwind we're currently pushing through. Let me leave you with a thought that reframes everything we just covered. 20 years ago, if you wanted to protect your wealth from geopolitical chaos, you had basically 2 options: gold or get out of markets entirely. Then crypto was born, and for a long time people debated whether it was a real hedge against instability, or just another volatile risk asset that moved with everything else. I think we're watching the answer reveal itself in real time. Bitcoin is not yet a safe haven the way gold is. It's too correlated with risk sentiment for that label, but it is the most liquid, globally accessible financial market in the world, and that makes it uniquely sensitive to macro signals and uniquely explosive when those macro signals resolve: when the Middle East calms down, when the Strait opens cleanly, when regulatory clarity finally arrives. Bitcoin won't just recover the ground it lost. It will move faster and harder than almost any other asset class on the planet, because the institutional money is already positioned, the ETF inflows prove it, the infrastructure is being built, the utility is expanding. The world is chaotic right now. But underneath all of that noise, a financial system is being quietly, methodically constructed that will outlast every single one of these headlines. Stay informed, stay patient, and most importantly, understand why the market is moving, not just which direction it's going. That knowledge is your edge. If this helped you see the bigger picture, hit subscribe and turn on notifications, because as this situation develops, I'll have updates the moment the signals change. Drop your questions in the comments. I read every single one. Stay sharp out there.